Okay. Hello, and thank you for joining today's webinar sponsored by the Access Forum. My name is Anastasia Papas, and I'm the director of the forum. This is our first webinar in 2022, and all of you who have followed our webinars the past year and a half, you will notice a difference. Webinars going forward will be organized along thematic sequences. In other words, we will select an issue related to climate change, macroeconomics, and finance, and organize 3 webinars around it. For the first 2 webinars, we will have presentations of research from academia and central banks. And the 3rd webinar will host a panel to discuss how theory can inform policy on that particular issue. Finally, a summary of conclusions will be posted on our website at the end of each series. The first issue we chose to discuss is how financial markets are pricing climate risk. And we're honored to have Stefano Giglio to kickstart this first group of webinars. On February 28th, there is Michela Scattigna and Omar Zulaika, both from the BIS, who will present novel empirical evidence on whether financial markets reward activity with perceived ESG benefits. The series will end on March 14th with a panel discussion. Panel members so far include Irene Monastirolo from the EDEC Business School and Sujit Kapadia from the ECB. Today, Stefano will present his paper, which is aptly named Climate Finance. Stefano is a professor of finance at the Yale School of Management. His research interests include asset pricing, macroeconomics, and real estate, with a particular focus on hedging macroeconomic risks using different financial instruments. Before joining Yale, Stefano was an associate professor of finance at the University of Chicago Booth School of Business. He has been awarded several prizes, including the AQR Insight Award, the FAMA DFA Prize for the best paper in the Journal of Financial Economics, and the UBS Global Asset Management Award for research in investments. He currently serves as an editor for the Review of Financial Studies. But before I pass the floor to Stefano, I would like to remind you to post your questions on the chat function and ask you to answer the short survey questions that follow. So the first question is, which of these research avenues are most important for improving our understanding of climate-related financial risks? And the second poll is, are the available data and models appropriate for measuring whether climate risks are priced appropriately by financial markets? So let's give it a couple of seconds for all of you to answer. So 38% answered to the first question. Deriving granular measures of asset level risk exposure is the best way to go, but it's closely followed by integrating proxies for transition risk exposure. The 32% voted for this one. And for the second question, 71% think that there's a considerable uncertainty over whether the financial markets are pricing appropriately climate risks. So let's see what our speaker thinks about all this. So Stefano, the floor is yours.
All righty. So first of all, let me 1 second share my slides. Okay, perfect. So first of all, thank you very much, Anastasia, for inviting me to give this presentation. And thanks everyone for attending. I will get actually to the answers that you guys gave to these questions in due time when I cover that. But let me actually get started. So today, I will talk about climate finance. And the broad topic of what I'm going to talk about today is the following, is that, you know, as I guess everybody here is aware, climate change is a very fundamental issue that is facing society, and it's affecting society both in the kind of in the short run and in the long run. And it's really a very complex phenomenon that, you know, requires kind of collaboration in some sense from many approaches, you know, from the physicists, they try to understand the evolution of the ecosystem, to economists, to financial economists, and so on. So when we think about the way that we can address, or the various aspects of addressing climate change and the effects on humanity, there's really a typical classification on two or three sides. One is mitigation, which is, you know, what can we do now to lower the risk or the damages, either the risk of very large damages or in a sense the damages themselves. So kind of preemptive action. There's adaptation, which is, you know, how can we do ex post, you know, given that some damages will occur, how do we react to those damages? How do we protect ourselves from damages from climate risk? And then there's monitoring, which is basically information production in some sense about how the system is evolving, what are the effects, and what we can do about that, right? In particularly, this is something I'm going to come back to later, given the fact that, you know, we currently have, you know, a lot of uncertainty about how the system actually works, how the dynamics will evolve over time. As we go forward, we're going to keep learning. And part of what we're going to talk about today is what can we do with the information that we develop over time. So what this has to do with finance is that finance itself and financial markets and finance research actually can play a role in contributing to a solution to climate risks. And as I will discuss in a second, this role will actually span all of these three different approaches: the mitigation side, the adaptation side, and the monitoring side. So the starting point for this review today, for this talk today, is that, you know, last year we wrote a review on the status of climate finance, or research in financial economics that is relevant for addressing climate risks. Now, this literature actually kept evolving, and this is by now is actually pretty dense field. And so I will not kind of review the entire field of climate finance. I will actually focus on one particular theme. So let me start by kind of setting the stage by saying, you know, what do we think? Why do we think financial markets are useful in addressing climate change? It's actually not that trivial in the sense that, you know, in fact, it's not, first of all, you know, thinking about the role of financial markets is not what comes to mind when thinking about addressing climate risk. The first thing that comes to mind is, you know, maybe reducing emissions, or, you know, extracting CO2 from the atmosphere. Other things that either kind of plainly in the physical realm, or maybe there's something about taxation that helps us kind of align the incentives in order to kind of address climate risks. And so, you know, then why do we look at finance? What is special about finance that can help us? And I think these are, in my view, the three main roles that finance can help us achieve. First, there's an information role. Okay, so there's, you know, as we know, financial markets are very good at aggregating certain types of information. Prices can be very informative, and in particular, I believe the prices can provide important inputs for economic and policy decisions. So they can be important for decision taken by individuals. For example, just to give you an example, if I want to build new constructions, the prices of houses in different regions can help me decide, you know, where is more profitable to build houses. Okay, and that's one way in which, you know, prices of assets can inform economic decision. And in turn, if the prices of assets reflect climate risks, then it in turn can help internalize climate risks in economic decisions. But it's also for policy decisions, right? As a society, we need to basically decide what path we want to take to transition to a sustainable economy. Are we going to go very fast? Are we going to go very slowly? Do we want a kind of drastic approach? Do we want a gradual approach? So as I will tell you later, my view is that actually financial market prices can actually help inform this kind of decision. So I would say that the information side of this actually spans both the mitigation, the adaptation, and the monitoring part of how we address climate risk. Now, there are other two ways, which are more direct ways in which finance can help. One of them is the fact that if at some point we want to transition to a more sustainable economy, one way in which that has to happen is that investments needs to be reallocated from kind of polluting activities to sustainable activities, you know, from fossil fuels to green energy, and from, you know, polluting methods of production to less polluting methods of production. So reallocation of capital from, you know, across sectors and also within sectors across different technologies, they actually, it passes through financial markets, because financial markets is where really funds go through to go from one use to another use. And so I think finance has a very important role to play in helping this transition happen. And that's actually, this is the one aspect I will not talk about today. There's been an enormous amount of work in theory about, you know, what is the role of financial contracts to achieve this goal. But also I want to say, this is something that is already happening in financial markets, kind of as a natural response to the demand from investors to have green investments. There's been a lot of progress in the financial industry providing to investors means or special contracts like green bonds and similar contracts that are precisely aimed at making this transition easier. Okay, so that's another important role that financial markets play, which is on the mitigation side. And there's a third role, which is, I think, has been a little bit neglected, and I'm going to spend a little bit more time on this today, which is managing and sharing climate risks, which really is a form of adaptation. Now, the idea behind this is simply that, you know, even, you know, let's say that, you know, we can be more or less optimistic of how much of the climate risks we can address via mitigation, you know, really how quickly we can cut emissions, how quickly we can absorb CO2 from the atmosphere. But what is certain is that we're not going to be able to completely revert all the climate change that has already occurred, right? So there's a certain amount of, for example, change in the temperature that is actually not reversible at this point. And so what that means is that, you know, despite all of our efforts, there will be some residual climate risks. And we know that these residual climate risks are not equally affecting the entire world population. There are going to be some people who are more affected than others. Okay, so for example, there are some countries, especially some developing countries, that we know are likely to be more, you know, to be damaged in a worse way if climate change really materializes in its full force. And so I think that to the extent that we have some uncertainty about what these damages are going to be, and we're kind of still on time to write contracts that depend on those outcomes, like insurance contracts, then writing down insurance contracts that kind of help us absorb those risks and share them globally. That's, I think, an important role the financial markets can play. And as I said, that's part of the adaptation. Okay, so this is what, like, the kind of the starting point of how I think about the role of financial markets. Now, as I said before, there's been an explosion of research, and I can't really kind of review all of it today. So today I will actually focus on one aspect of this, which is the importance of prices in financial markets, and how can they. So first of all, what can we learn from the prices, and how can we use this information to achieve some of these objectives? So on the adaptation side and on the mitigation side. So the kind of the little outline for the next half an hour or so is going to be that I want to cover these three topics. First, I want to actually cover something was asking one of these polls at the beginning, which is, do we believe that climate risks are reflected in asset prices? And if so, by how much? Do we think it's correctly reflected in asset prices, or maybe it's only partially reflected, or maybe we have no idea? So I'm going to try to address that, because it turns out that, you know, many of the tools that we have developed in kind of microfinance, you know, microeconomics and finance empirical work in the last kind of 20 or 30 years, they become very useful when we try to understand, you know, these kind of micro effects of, if I take different assets, can I see the different, like, climate risk exposures reflected in the price of the assets? So we can apply these finance tools to this question, and we can actually give kind of a reasonable first answer to the question of whether climate risks are reflecting asset prices. So I will start from that, reviewing some recent empirical work they've done. And I will, of course, mention also what else has been done by other teams. And then I will give you two examples of how this information can be used in practice. I'm going to think about how we can use this information to adapt to climate risk, how we can use it to share climate risks. And then I'm gonna talk about how we can use this information to help inform policy making. Okay, so these are the three parts that I would like to cover today. So let me start from the first one. This, in a sense, is a very kind of broad question. And it just says, look, do we think the climate risks are anyhow in any way reflected in asset prices? Okay. Now, this, as many of you pointed out in the poll, the most answered question in the poll choice was, that we maybe just don't have no idea. Okay, with too much uncertainty to really be able to really answer this question. I would argue that, in some way we can actually answer positively that climate risk is exposed. I try to convince you of that. But I think the point here is really highlighting that we do have a lot of uncertainty. It's really very hard to give an answer because many of the items that enter the answer are just not very well defined. For example, what even is climate risk? Okay, there is not one thing really that is climate risk. There is, climate risk is a combination of many different things. Is it, the potential change in temperature? Is it flooding? Is it other forms of physical risk? Is it, should we think of climate risk really mainly through the lens of transition risk instead, in the sense that maybe physical risk is really so far away in time that is not that relevant to people, but instead we should focus on the short term, which is how the government will react to climate risk, to this physical risk inducing transition risk. So, there's a kind of first question of measurement of, what is the risk exposure that we're trying to capture? And then, how do we even after we decide, look, this is how I'm going to define climate risk, is, your exposure to hurricanes, for example, how do we measure that? Many cases, it's actually very difficult to measure beta with respect to something which is not very easy to measure. Okay, for example, some weather events that are, a very clear manifestation of climate risk, they're very rare. And so it might be very difficult to figure out what the exposure of different assets are to these climate events. And in many ways, in another sense, things are changing very fast. So, what we learned from let's say, from data from 15 years ago might not be relevant anymore because maybe the exposures have changed over time. So measuring climate risk is also difficult. And then there's an identification problem, which is really common to basically every other microeconomic analysis, empirical analysis, which is, am I really, when I go and measure some exposure to climate risk, am I really measuring exposure to climate risk, or I'm measuring some other confounders that just simply happen to be correlated with exposure to climate risk, okay? So these are all very difficult questions, and basically every empirical work has to make a million decisions on how we're actually going to implement the analysis. Okay, so this is dangerous, right? Because it opens the door to to data mining, to to basically search for specification, which is of course detrimental to good empirical work. And so we are now at the first stages of a very large wave of research that have asked this question in many different ways. And even though we know that every individual study have had to make many of these decisions, I think the overwhelming evidence is that collectively across asset classes, using very, very different methods, we do find pretty clear evidence that investors are starting to price in climate exposures. Okay, so I want to give you two examples of this. Before that, I should also say one more thing, which is the answer to this question of what is climate risk and what are climate risk exposures and so on, they're actually not unique. They actually depend on different asset classes. So for some asset classes, it may be the transition risk is more important, and from other asset classes, maybe climate risks are important. To give you some examples from asset classes that people actually have worked on, and for which we actually do have empirical evidence, here's a few, right? For real estate, you're obviously worried about direct physical risk because there are wildfires affecting, for example, California properties, or flooding due to changing the sea level. That's so physical risks are important, or maybe are most important. And then when you look inside of equities, it's very clear there are at least some sectors and some companies that are very directly exposed to regulation. That for them, that's the main risk. For example, if you're a fossil fuel producer, well, then you're certain your first order worry is that the government will come and, you know, and tax in some way the use of fossil fuels, for example. Okay, so transitional regulatory risk seems to be the main risk in the equity space. If you look, for example, municipal bond, which has been a very active context to study the effect of climate change on asset prices, when there, you know, the physical risks are very important, because for some municipalities, they're just located in areas where they're very directly exposed to the physical risks, and they actually need to spend money to protect themselves from these risks. They need to build seawalls, for example. And of course, more indirectly, the tax base is kind of directly affected by the risk as well, because it's of the physical location. And so, you know, it's kind of very natural to think that municipal bonds will be affected by physical risks. And finally, there is sovereign risk. There are countries like Bangladesh that are more exposed directly to physical risk, and there are other ones that are instead more directly exposed to transition risk, again, because of the link, for example, to oil. Okay, so there's actually a variety of different exposures that really vary a lot by asset class. And so, which is something to keep in mind, because of course it will affect the way you want to measure climate risk when you go do your empirical work. So, what is the main issues? What are the main issues in identifying and measure risk exposures? Well, I would say that there are two most important issues. One of them, as I mentioned before, is just the scarcity of historical data. So if you think about the way we measure risk exposure in finance, right? Think about, you want to understand what's the risk exposure of a stock, right? Well, you're going to have your main definition of risk. Let's say you believe in the CAPM, you're going to use the market as your risk factor. How do you understand if a stock is exposed to the market or not? Well, that's easy. Very likely, this stock has been around for decades, and you just go in the historical data and, you know, empirically measure based on the correlation between the price movements of the stock and the market. Well, you can't do it with climate risk, because investors were not pricing any climate risk historically. And so if you look at, you know, whatever is your measure of climate risk, you're going to basically find zero correlation for anything that goes beyond the last 10 years. So we just don't have a lot of data. That's going to be a very big deal. It's going to be a very big deal in understanding risk exposures, and I'm going to argue later, it's going to be an even bigger deal once we start thinking about how much climate risk is actually priced in financial markets. And then, as I mentioned before, there's all this idea that, you know, we're trying to really identify kind of the causal effect of risk exposures on prices, but we need to account for a lot of potential and observable confounders. Okay. And so we're gonna need to kind of figure out some clever identification strategies that really help you kind of tease out what is really due to climate risk. And as I said, we really benefit here from having decades of experience in other contexts, in which in other financial contexts. Okay, so here's an example of a paper that I've written with several co-authors, trying to understand the pricing of climate risk in real estate. Okay, so, you know, again, this is not like a universal strategy. This is an identification strategy that works in this particular context. They might not work in different contexts because we're exploiting something peculiar about the housing market. Okay, so the question here was, do we think the houses reflect exposure to climate risk? So what did we do in this paper? We looked at 4 states on the east coast of the US, including Florida, and here's the map of Miami, okay, downtown Miami. And what do? We look at all house transactions. So there are all the dots you see in this graph. And we're basically gonna use the NOAA maps about which houses are exposed to a potential 6 feet sea level rise over the next 100 years. So these are houses exposed basically to long-term climate risk through flood. And you can see that some of these houses are red and some are green. The green are the ones that are not exposed, and the red one are the ones that are exposed. Okay, so the most immediate way to figure out if there is a differential impact on climate risk on these 2 different types of houses is to just compare the price of green and red houses. You could say, well, if red houses are more exposed to climate risk, they should trade for a lower price. Let's compare the average price of the red houses with the average price of the green houses. Okay, now that's all fine, except that, of course, these red houses are not randomly distributed. Okay, you can see they're basically all on the beach, right, or on the coast. So, of course, that already is an indication that maybe this kind of a naive approach of comparing price levels is not a great idea, because basically is affected by a confounder, which is simply that there are amenities that are also related they are correlated with exposure to flood risk. Basically, if you're on the beach, you get a better view, but you're also more affected climate risk. And so how do we take account of all these confounders? Well, one possibility would be to really have very, very fine data, maybe on the exact views of the house that maybe differ by floor. We don't have that data, okay? There's always a concern there will be some unobservable variable that we are not controlling for that is correlated with the price level. And so what we can do instead, we can try to do some sort of diff in diff, okay? That try to control for example, for local confounders. So this is the identification strategy that we came up with. It might not be perfect. There's, obviously every identification strategy has flaws, but we think at least goes some way in addressing this concern. So what do? We try, rather than comparing the level of the price changes, we're going to compare the reaction of price changes to how people perceive climate risks. So the idea is that rather than thinking about how prices move when an event happens, because the event might not capture climate risk, it might capture, for example, the fact that it was a flood that actually affected prices. We're just going to try to move the mental experiment is we're going to try to change just the people's perception of climate risk and see when people's perception of climate risk changes, do we see a differential response of prices in exposed areas versus price in not exposed areas? Of course, this is going to keep fixing difference out everything which is kind of local, which is not changing together with the perception. Okay, so that's the idea. So how do we figure out, how do we measure people's perception of climate risk? Well, what we do is we go and look at house price listings in different areas for county by county, zip code by zip code. This is an example of a listing. Okay, it says down in the rough on water with pier and dock. Owner holds letter of exemption from FEMA, stating high elevation flood insurance may not be required. Okay, so the idea is we look at all the listings and we check whether we know which of the listings are talking about kind of climate related issues. For example, this is a listing which is clearly aware of climate risks. And we basically measure in each zip code what fraction of the listings seem to be talking about climate related risks. Okay, and we build an index basically zip code by zip code over time that says what fraction of the zip code seem to be a kind of particularly aware of climate risk. Okay, so you can see this is something that changes by zip code and over time. Okay, so this you can see here the map of Florida. You can see by color is the variation in this index, which we take it as an attention to climate risk in that zip code at that point in time, and this is a variation over time. Okay, and what do we do? Basically, we do this diff experiment. We ask, when we see the particular zip code, a particular point in time, there's particular high awareness by in the real estate market for climate risk, do we see prices of risk exposed houses decrease more than the other houses? Okay, and we do find indeed that that's the case. Okay, so there's a significant effect of increased perception of climate risk. Okay, so there's, of course, I'm not going to go into the details of the many robust tests we do in the paper. You can look at the paper for that. But the bottom line is that we do find indeed that the perception of climate risk seems to affect the price of houses in the real estate market. Okay. So now, of course, we're not the only one working on this topic, and there's many other research teams in the last, let's say, 5 years or so that have worked at looking at this kind of analysis in other markets. So there's been work on equities, on sovereign bonds, on sovereign CDS, on corporate bonds, on municipal bonds, on mortgages, and so on. And in each case, there's been a different identification strategy, but I would say there's been, with very, very rare exception, there's been basically a consensus building up that indeed, climate risks are reflected in asset prices. Okay. Now, I want to give you one more example, because then I will use this idea to kind of expand on what we actually can do with these prices, and that's the climate risk exposures affecting the prices of equities. Now, one advantage of equities compared to real estate is that we have actually pretty natural measures of climate risk. They're not perfect, I was going to argue. In fact, they're pretty bad. But it's been quite a while that people have, the researchers and the industry have tried to come up with measures of of how the firm is doing in terms of ESG in the ESG dimension. Okay, and in particular, I'm going to focus in this presentation on the E side because that's what the environmental side, which is what directly affects obviously exposure to climate risk. But we do, firms for a very long time they have been studied by investors in trying to understand how well they're doing in these dimensions. And so we can actually use this work to kind of help us figure out which firms would be more or less exposed to climate risk, right? So for example, if we think that there's for example, the E-score of a company is good at capturing climate risks, then what we should expect to see is that high E-scores or ESG scores companies should do well or better than low ESG score companies when there's a climate event. Okay, so for example, there's something that is recognized to be bad for the climate, the collapse, for example, the Paris Agreement, or the US pulling out of it, and that's bad for the economy. That's bad for the climate, and so we expect high E-score companies to do better than low E-score companies. Okay, or we certainly start obviously like very more directly. Maybe you start regulating coal, and then you start kind of taxing coal or taxing oil, and you'd expect kind of green companies to do better than polluting companies. Okay, so maybe this, I'm going to argue later, the E-scores are actually not a definitive measure of climate risks, but they're a first measure of climate risk. Okay, now what are the main empirical issues with this? Is that E-scores are ultimately the ones that we have so far, they're actually not that reliable. So there's been a recent study, or is a few set of studies by Berg and co-authors, basically try to figure out, how informative the E-scores are. And it turns out they're not that informative. And a sign of that is that you take data from different providers and just doesn't seem to line up very well. Okay, and so there's a lot of noise basically in these measures, which I think is actually pretty reasonable. And I think it's something that's going to be addressed in the future, because now there's much more demand from investors to have good measures. And I think the industry is responding by providing more high quality measures and refining the existing E-scores. Okay, so I think this is a problem that's going to be slowly resolved going forward. And then, there's the same issue I talked about before, which is, when I say a climate event, what do I mean by climate event? What is a climate event? Is it, a new IPCC report that really scares us about the future? Is it something about regulation? Is something about international cooperation? Is something about we discover out the climate? Is it actually some heat wave that hits the entire world or the entire US? Is not that clear. Okay, so these are all things that we need to kind of think about when we try to study how climate risk are reflected in equities. So basically, I also wrote a paper with a partly overlapping set of co-authors trying to figure this, figure out whether climate risk are priced in asset markets. And here we took a different approach because we thought it was better suited for thinking about climate risk in equities. And so what did we do there? We took we tried to build the climate index from newspapers data. Okay, so the way we do it, we look first at a set of publications issued by a government organization, and they were targeted to communicate to the layman basically some climate concepts. So this is language that straddles both the scientific language, but also the non-scientific language, and just to communicate basically climate, the climate concepts. We built a glossary, which you can see represented here on the right-hand side, using these white papers. We build the vocabulary, and then we take a Wall Street Journal, and we say every day, how much is the Wall Street Journal using language that looks like this kind of climate language. Okay, so basically our measure of climate news or climate events is how much the Wall Street that is relevant for investors is going to be how much the Wall Street Journal is talking about this kind of is using this climate language. Okay, so then we're going to say if we see the Wall Street Journal talking a lot about climate topics, it must be because they're talking about some climate risk, something about the climate must have happened. And so we've obtained a time series of climate events, which are basically, you can see that they're all completely extracted in this kind of machine learning way, but actually line up pretty well with what we think are, the main events of the day. You can see something related to the Kyoto Protocol, you can see the IPCC formation and so on, okay? So we do think it's a pretty good measure to capture climate events. I should also say that over the last few years, after we wrote our paper, there's been many researchers that implemented over our measures. So now you're going to find better measures that really focus on transition risk, there's differentiating versus physical risk. And this was kind of a proof of concept has been greatly improved in recent research. And so then what do? We basically do the same thing we did for real estate, and we go, I'm not going to show you the details of this, but we go and actually check to what extent firms, when an event happens, is it true the high E-score companies go up in values or go up in value more than the low E-score companies? Or in other words, if you build a portfolio that goes long E-score companies and short low E-score companies, do you actually make money in times where there's a climate event? And the answer is yes. So it's a sign that the market, at least now, is incorporating climate effects in asset prices. Okay, so I think that overall, the preponderance of the evidence right now is truly that the markets are incorporating these climate events and these climate risks. Now, one question that I don't have the answer to is the much harder question of quantitatively speaking, how much are these prices moving? Are they moving correctly? Right? It's a much harder, when you're just testing that the null is zero, that they're not moving, it's easy to reject that in the data. But here we're thinking really about a different null, which is, are they moving by the right amount? When when a house has a lower price, everything is equal because it's located in a flat zone, right? Is the price lower by the right amount? That's very hard, okay? And a different way to think about it is that, if I buy a portfolio of high climate risk companies, right, I should expect high expected return because they're risky. When I buy a portfolio of low E-score companies, right, let's say green firms, I should expect low returns because they're not very risky, right, with respect to climate risk. So do I see this difference in expected returns in the data? Well, here's really, I don't think we can say anything right now because we don't really have much data to work with, right? We only have, let's say, 10, 15 years of data. And when you're trying to get expected returns, you just need long data set. Okay, so let me give you an example of what I mean by that. Suppose that you look at the last 15 years, you say, look, green investments have done pretty well in this period. Now, I give you two hypotheses. One hypothesis is that maybe green companies just give you on average high expected returns. Why? Because they're risky, which is completely opposite to the story I just told. Or maybe truly they have low expected return in the long run, but during these 15 years, it was just a sample that had bad climate news. So green companies happen to do well in this sample, but in the long run, they will revert to doing not so well because they're really hedges. Well, I can't tell you the difference in 15 years. And there's a lot of work that's been done trying to really say something very strong about expected returns. I don't think that's warranted. I think that's very hard to really say, okay? So the bottom line is, do we think climate risk is pricing? Do I think climate risk is pricing in these markets? Yes. Do I think it's properly priced? The answer, I don't know, okay? So in the last 5 to 10 minutes, let me just mention a few more things. So first of all, this exact idea that some companies go up in value when climate risk happens and others go down in value can be used to build a long short portfolio. As I said before, basically is making money in bad climate times and losing money in good climate times. That's an insurance contract, right? That's a synthetic insurance, okay? And this is extremely useful because we need insurance type contracts to be able to share these risks, right? So in an ideal world, we will have an insurance contract that people in governments all around the world could buy right now. They would say, contingent what happens with climate risk, if I have a flood here, or if my country is particularly affected by floods, I'm going to receive some money that I can use, for example, to rebuild, to build seawalls, to move my population to safer areas, all these kind of adaptation measures. And if climate risk ends up being not so bad, okay, then I will just pay an insurance bill. Okay, so I think that having an insurance at the global level, it will be extremely good. But unfortunately, contrary to other risks, like let's say inflation, we don't have a good derivative market that really specifically target that risk. So right now, there's very little countries can do to hedge themselves against these kind of global climate risks. And I think an important part of adaptation will be making sure that whatever residual risk there is there, we can share it globally. And we can do that basically. I'm going to go directly 1 second to the different approaches because of time. But basically, we actually know, again, from the financial literature, we have many different approaches that we can use to help us hedge this risk, to help us build a synthetic portfolio. So even if I don't have access to an insurance contract, I can use it to hedge. So I can do what's called the narrative approach, which is basically I'm going to use my own prior information. For example, I believe that Tesla will do well and traditional companies will do bad. Okay, that's traditional energy companies. That's possible. Okay, it's not my favorite approach because your intuition can be wrong, and so I think it's much better to use data to inform how you're going to build this hedging portfolio. But in finance, we have developed many approaches. There's a standard making portfolio approach which just says, I'm going to look historically which companies did better, which company did worse. I'm going to basically make my decision based on that, how to build these synthetic portfolios. I have a new paper which I'm not going to talk about, in which we're proposing a new approach that looks how people respond to climate shocks to help build these portfolios. Okay, without going into the details of all this research, the point is, by understanding how different firms react to climate risk, we can build a better long-short portfolio that can help us, that we can put in place now to then hedge climate risk when then it materializes. So that's one way we can use the information in financial prices to help us deal with climate risk. So finally, let me just mention, in the last 5 minutes, I would like to mention one other application of how we can use financial prices, and is that, as I mentioned before, prices can be important inputs in deciding production and investment on the private side. For example, to give you kind of the full example here, if prices are correctly reflected in the housing market, then houses on the coast should be particularly discounted. Okay, it should be less convenient for to build new housing there because it's going to be less valuable to investors. Okay, these all assuming that we're in a frictionless market. But, there's a lot of frictions really in the real market. Similarly, if I'm an investor and I want to invest in different sectors, basically financial market prices should adjust in a way that helps reallocating money towards green investments. But I want to emphasize there's also a lot we can learn that is directly useful for policymaking. Okay, so what do I mean by that? Is that it's actually, policymakers actually do have to make a decision of how we're going to reach a sustainable path for the global economy. This is the job of the policymakers because there's an externality here, right? So we know that on its own, the market system without guidance, without either informal tax, Pigouvian taxation or cap and trade, whatever, some form of intervention from the government will not reach the optimal path. So there's a lot of scope here for active intervention from policymakers. And the policymakers' problem is very complicated because the policymakers need to understand the physics of the problem, of the climate dynamics, how the climate dynamics affect the economy, but they also need to understand what are people's preferences for time and for risk, right? Are people very patient or not very patient? Do they really worry about long-term climate risk or they don't worry about long-term climate risk? All of this information matters for how policymakers make their decisions. So here's an example from one of my older papers about how we can use financial markets to learn about long-run discount rates, which are a very important input in this decision. How much do we care about the dollar, 100 years from now? So in just 2 slides, let me give you an example of how we approach the problem. We somewhat randomly, we discovered that in the UK and in other countries, when you buy a house, you can buy a house forever, which is called a freehold, or only for a limited amount of time, which is called the leasehold. Now, if you buy the freehold, look at just simply at the graph. If you buy a freehold, you get basically the flow of utility or the rents of the house forever. If you buy a leasehold, you only get it for, let's say, 100 years. Which means that if you think about conceptually the difference between a freehold and a leasehold, so imagine you could see the same house sold as a freehold or only as a leasehold, so it comes back after, let's say, 100 years. The difference in price reflects the value of this cash that arise from 100 years on. So what do we do in the paper? We went to we look at the UK housing market. We actually went to measure the discount between similar houses that are sold as leaseholds versus freeholds. So sometimes even in the same building, you can see some flats that are freeholds and some flats that are leaseholds. And so what was striking in this research was that, there was, so this is the discounts for example, this first bucket is leases with 80 to 99 year maturity, the discount relative to the freeholds. That's a 15% discount, okay? At 100 years, it's about 10% discount. And then, it drops at 1,000 years, there's no discount anymore, which makes sense. So this says that people are willing to pay 10% of the basis of the value of the house to get those cash flows around after 100 years, so to keep the house after 100 years, okay? That means that in a sense they're patient, they care about the long-run future. Well, you can translate these numbers into discount rate to apply to these cash flows 100 years from now, and that's 2.6%. That's a very low number, right? So if you look at the debate in climate change, what are the right discount rates for this kind of climate mitigation measures? Some people propose all the way to like 6 or 7%. That basically means that you're not going to invest anything in the long run, because it means people don't really care about anything, let's say beyond 30 years. Well, with a discount rate 2.6%, which we find in the housing market, you would actually, put some, noticeable value in cash flows that are in long run cash flows. But what's even more interesting in some sense is that actually this 2.6% is an upper bound on how much you want to invest in climate mitigation, because 2.6% is a discount rate on a risky asset. Housing is a risky asset. That must be above the risk-free rate. And the risk rate in turn is above the discount rate to apply to mitigation projects that basically have negative beta with respect to basically hedges. They're negative climate beta, right? So anything that actually helps you reduce the risk should be discounted at a lower rate than the risk-free rate. So this 2.6%, in fact, is a very strict upper bound on what we think is the right discount rate for mitigation process, mitigation investments. So this is all to say that we think that in a very kind of model-free way, we learn something very, very important for policymaking from financial markets, which is, well, people do seem to care very, very much about this long term, and that this 2.6% is an upper bound on the appropriate discount. Okay. So it was kind of a bit of a tour de force. I understand that. This is the conclusion, that I think financial markets play a very important role in addressing climate change on all these three fronts: on the information production front, on the adaptation front, on the mitigation front. And I think that we're at the stage where there's a lot of research. So far, we made some progress on the basic question. For example, is climate risk priced at all versus the null of it's not priced? These answers are obviously not sufficient for us, right? There's a lot more that we need to do. In particular, we need to start to learn how to give quantitative answers to these questions, okay? Which of course is hard because, as you pointed out in the poll at the beginning, there is a lot of uncertainty in all this, okay? In the climate process, in the response of the economy, and so on, okay? So it's a really wonderful area of research, and it's an area where I think there's going to be a lot of very useful interaction between policymakers and the industry and researchers. And I'm going to stop here because I want to hear your questions. Thank you.
Thank you, Stefano. This was a very, very interesting presentation. Let me start with a question that Rick van der Ploeg asked, and it's, how about sudden probability of a breakthrough in renewable technology? Is that a policy transition risk?
So yes, absolutely. It's another one of the diseases we really, really have a hard time quantifying. And so in some sense, that's obviously gonna, let me say the following way. When I talk about climate, let's say this kind of climate risk or regulatory risk, there's even a variety of different types of risk in the transition risk. So one type of transition risk is regulation risk, right? Or we're gonna go and actually go and tax carbon emissions or do some other intervention of that type. But for sure, some breakthrough technological innovation is another type of transition risk, which might have completely different effects on firms. And so in a sense, if you really want to understand how to, for example, build a good hedging portfolio, then you really need to think about not just one type of transition risk, but many types of transition risk. And that makes things even more complicated because many of the risks are just very, very difficult to quantify. Yeah. Thank you.
Before I go to questions by the audience, I have a question. So how do we really model climate risk? Is it something that damages the economy little by little, year after year? Or is it something that happens in the future, way into the future?
That's a hard question. Okay. That's a very difficult question, but it's actually useful, I think, to think about. So let me just say for it, it's a very difficult question on which we actually have made some progress on, in the sense that if you actually think about how all these research of climate and economics started, there was basically no risk, right? If you think about Nordhaus's old paper, it was actually a deterministic world. Then people started to add risk in different forms, different shocks, maybe parameter risk, parameter uncertainty. And so nowadays, I think we have more, we have richer dynamic models, which incorporate kind of all different kind of feedbacks and the risk involved in them. Now, there is this kind of bifurcation in some sense of thinking about climate risk as something kind of slow and steady that kind of keeps accumulating. And in a sense, this was kind of closer to the original Nordhaus view of climate risk is basically a cost, like a tax on society that we're going to keep paying. It's going to kind of eat up resources over time versus, at some point there's going to be the tipping point and then everything is going to collapse and there's going to be an acceleration. And I think really where the research here is going is trying to integrate what we learn from the physicists about, about really how the processes look like, and what we learn about the economics research about how this impacts the economy. And the two don't need to even be the same, because you might have, for example, if you have, if the economy is prepared for these climate events, you may have very abrupt events in the climate side, but then the economy is able to absorb and maybe spread them out over time, for example. So I think, I obviously don't have the answer to that, but I think we are making progress by having more sophisticated climate climate process models, and also having more sophisticated models for the economy. And that's kind of the way it's going to go. And one last thing I want to say is that we know very little now, but we are accumulating knowledge at pretty fast pace over time. So, over the next 20 years, we'll certainly know much more about this, and it's going to be easier to kind of also to react to this. You're muted.
Thank you. One other question, actually, a couple of questions on that issue on ESG. You did mention that the need of standardization will eventually sort of happen. So ESG labels will end up being more standardized. But there's the issue of greenwashing. So what happens in that case? How do investors take greenwashing into consideration? Do we need more regulation, or this is also something that financial markets would eventually deal with it?
Right. So, this is, my kind of view of this is, first of all, we don't want to be in the equilibrium where there's just general distrust. So something needs to be done. And otherwise, the whole equilibrium collapses. It's like the lemon problem. So there are really two ways forward in respect to this. One is that we kind of that the private market for basically auditors kind of develops more, and there are a few auditors that get, and we already have basically the certification process already going on for other things like for credit ratings. And so either that by itself is sufficient, or we're gonna need the government to kind of say, here's the way we're going to do it, and, this kind of certification is going to be, enforced in some way by the government. Now, which is going to prevail at the end? I don't know. I suspect that different countries will try different approaches. And that's been true for many aspects of climate risk. And so I think that ultimately it's probably a combination of the two. I do think financial markets on their own absolutely have the ability to deal with this problem, but there's also very strong interest from government to make sure that things actually work properly. It's really a first order issue for governments too. So I think it's going to be a combination. Exactly which combination is going to be different across countries.
Perfect. Next question by James Vaccaro. He's asking, given the asymmetry between past and future in terms of climate outcomes not seen before, what tools other than extrapolating historical data sets can be used to price assets?
Yeah, that's another good question. Unfortunately, I have a lot of thoughts, but I don't have great answers, I guess. But I think that in the face of uncertainty about what the process is going to look like, I think stress tests are going to be a very important tool, in the sense that that's something that was really highlighted by Weizmann in his pioneering work, maybe 20 years ago or so, that really what's really crucial and really key about this particular risk, just how little we know and how much uncertainty there is. And what can you do when you have so much uncertainty? Well, as an investor and as a policymaker, you really want to make sure you don't miss out on the really bad case scenario. So from the point of view of investors, I think more than extrapolation, what we need is, when you think about, I think extrapolation actually is a bad idea, because it kind of gives you, in a sense, over reliance on one particular potential path, and it can lead to ignoring the various potential outcomes. I think what's more fruitful is to think about, given what we know about the processes and the economy and the interaction of climate and the economy, what are the possible scenarios, and what can we say about the probabilities, and then do stress tests, even to with respect to unlikely but possible scenarios. And that's a more robust way, I think, to make decisions for investors here.
Gerhard Mulder, and I apologize if I'm mispronouncing the name, is asking, what about the discount rate to account for damages? Can we use negative discount rates to account for intergenerational equity?
So that's a great question. So the discount rate, there really have been two approaches to discount rate in the literature, right? One has been kind of the ethical approach. It just says, I'm going to discount the future at, I'm going to choose a discount rate based on purely ethical considerations. The other approach has been, I'm going to kind of try to elicit or figure out what is the discount rate that people are already using in their day-to-day life. So that's the approach that I've been using, for example, when I was looking at the housing market, right? People are already thinking about their kids and their grandkids when they're buying houses, right? They think of leaving them as inheritance, or they mean, to enjoy them for a very long time. So I've been extracting these countries from this data. So basically, implicitly try to understand what's going on in actual people's minds. Now, I kind of I think most which one do you want to use is a little bit a value judgment, but I do want to emphasize that it's not that because you're using a market approach, you won't end up with a zero discount rate anyways. Because as I mentioned in the case of when I was talking about the housing market, right? If I'm thinking about an investment whose job is to mitigate damages, which I think what the question is about, well, that investment is like insurance, right? It's an insurance contract where basically I make an investment today, I get paid basically if there's a bad realization of the climate, which is a bad thing, right? So when I buy insurance against, for my, let's say, against the fire on my house, I'm willing to lose money on that, right? So I'm basically accepting a negative discount rate on those cash flows because they're happening in a bad time, right? I get paid when my house burns down. So even if I use a completely market-based approach and I don't have any special regard in some sense for future generations, I might still end up with a zero or even negative discount rate because I realize that what I'm buying is insurance against those damages. And so in a sense, I think there's no need to have an exogenous imposed ethical approach. I think the tools that we have today and our understanding of risk and return are more than enough to actually end up with something which we think is, maybe aligned with our judgment, which is that we should have low discount rates for this kind of cash flows.
Well, thank you very much. We came to the end of our webinar. Stefano, many thanks for a very interesting presentation, and thank you all for joining us today. Don't forget to register for our upcoming webinar on February 28th. So we continue the conversation that we started today. Many thanks again.
Thank you.
Bye-bye.
Thanks. And if you have questions, you can always email me.
Actually, yes, you can always send questions at info@theaccess.org and we forward them to
Sounds great. Thank you. Thanks, Anastasia.
Bye-bye.
Bye.